Ali, can you hear me? Okay, everyone, getting a good list of people joining here today.
The proof about technical analysis.
So I'm going to only expect about a dozen people here, so I'm going to allow everyone to talk so you can ask questions. Typically, when we do some webinars, we keep everybody muted so that it doesn't get too many questions. But I think we got a dozen people here or so, so I think we're all going to be good.
So unexpected.
I see Tom Reddy has joined us. Hey, Tom.
How are you, Professor Brookshire?
Hey, great, Tom.
Great. Thank you.
Yeah, we're getting about a dozen people, so just going to wait another minute or so before I jump in and get started.
Absolutely.
I see a lot of names here that I recognize, so that's great. Trying to get everybody turned on since it's a small group, so feel free to ask questions. And then I'm just going to get started slowly and let people join in a few minutes late. Then I'm just going to jump right into the option spread pit. So, yeah, people are still coming in. That's great. Yeah, so I'm enabling everybody. So if you're working, if you could just mute yourself, if you want to ask a question, of course, unmute yourself. Okay, so welcome everybody. My name is Mark Brookshire. I'm the founder of StockTrak. Wrote this virtual trading code about 33 years ago now. So it's been quite a ride, lots of fun. And for some of you, I recognize your names. You've been with us for a long time, so I appreciate you using StockTrak in your classes. We've had a lot of requests in the last couple of years for us to improve our option trading pit. And so we undertook a project about a year ago to update it and make it more of a real life trading experience for the students. So initially we just had buy and sell calls on StockTrak, and then we added the ability for students to write calls. And then we added the ability for the students to do spreads. But as more and more professors are talking about multi-legged trades, we wanted to update our trading pit. So we've done that. So I'm going to just jump in and start sharing my screen here. Right here. Okay, so I'm logged into StockTrak now as a student, and I'm in a class that I set up as Mark's Full Demo. And just to remind you about the StockTrak platform, the students come in under portfolio simulation, and here's the trading. And for this demo, I've activated everything that we trade. So one of the new things for this semester is we did move crypto into its own trading pit. Previously we had it tied to the stock trading pit. But then with diversification and other rules, professors asked us to move it into its own pit. So crypto is now in its own pit. The options trading pit is just the single leg option trading pit where the students can come in, and I'm a big Tesla fan, so I'm going to try to do a lot of examples with Tesla. So in the single leg option pit, students punch in the ticker symbol. It shows the last price of the underlying stock, and then the student can buy, sell to open, and buy to close. And then what we've done, if you haven't seen this for a while, is we've broken it out so that the students really are handheld as they create just a single-legged trade. So if Tesla's at 257 and I think it's going to go up, I might be looking at buying a call that expires this Friday. And then with the strike prices, the first thing I really want to point out to you is that what we've done here is we've populated the strike prices that are within 20% of the underlying stock price. So Tesla might have a 190 or a 150 or even a 100 call that's been out there forever. But in a simulated world, we find that the bid-ask prices sometimes get crazy. There's no volume there. So what we try to do is narrow the students to focus on something relatively close to at the money for the option. So for Tesla, we're displaying the 195s through the 320s, which should give the students a good range. And if for some reason students need to see all of them, they can click on the all button and it will show all of the available options. With Tesla at 257, if I think it's going to go up, I just might jump in and buy the 260 call. So in the single option pit, very straightforward. I might buy one contract. Our order types are market, limit, and stop. And then for the limit and stop, there's also a duration for the order.
Professor Brookshire, could you please share your screen? I'm not able to see it.
Oh, you're not seeing my screen?
No, I'm not.
Okay, well, sorry about that. How about now?
Thank you.
We can see your screen now, Mark. Thank you.
Okay, sorry about that. Let me just jump back to what I was showing you. So with the single leg option pit, I got to it by going to portfolio simulation and coming down to make a trade. This was the cryptos part that I was talking about. And we have options, which is the single-legged trades, and then the spreads is down here in the spread section. So what I just went through was I clicked on the option for the single leg. I punched in Tesla. Students can buy, sell to open, buy to close. And then the students don't need to know the ticker symbols. So we allow them to choose whether it's a call or a put, what the expiration is, and then they get to choose what the strike prices are. And with the strike prices, when I click on that, does everyone see the numbers here, or do you just see a black box?
We see the numbers, Mark.
Okay, great. So with the strike prices, what we display are those that are within 20% of their underlying stock. So that's what I was saying earlier. That'll become more important when we jump over to the spread trading pit. So with this part of the trading platform, which is the single leg trades, it's very straightforward. Students do not need to know the ticker symbol. They just need to know what the stock they want to trade is. And then we help them choose call, put, the expiration, and the available strike prices. One of the important things that you need to understand with the difference between the real world and the simulation is that there may be a bid ask on things and some liquidity, but in a lot of options, if a student goes to try to trade something that's way out of the money or way in the money, if there's no volume on that option today, then our default rule is that the students can't trade it unless it trades in the real world. So when you have your students trade options, I think the number one thing to talk to your students about is to find stocks and options where there's liquidity. So if they're trading Tesla, if they're trading Walmart, trading Microsoft, trading Netflix, trading the S&P, the Diamond, lots of liquidity there, both deep in the money and deep out of the money. But if your student tries to find a stock that has very low open interest on the options and they go to trade it, and if it doesn't trade in the real world today, then we do not execute the price. So we want the students to trade liquid options so that the prices are good and that there's volume each day. So that's kind of the number one takeaway with options. And one of the slight differences between trading options in the real world and in the simulated world. We have to have a good price and a good bid ask. A quick comment about the single leg trades for the for writing a naked option. We use the CBOE option margin calculations. So that calculation is 20% of the underlying value of the stock plus the premium received less the out of the moneyness. So there is a margin requirement. That margin requirement can be met with that amount of cash. And the way that our calculations go is they can have that amount of cash or twice that amount in equities that are marginable. So that's the second point that professors need to know when they're having their students trade options, is that there is a margin requirement. And we have students that come in and say, well, if Tesla's at 257, I just want to write 1,000 of the 290 calls, knowing that Tesla's probably not going to get up to 290 in the next 2 days. And they think that there's free money out there. Well, there is really not free money out there. You quickly eat up your margin requirement and your buying power if you start writing these calls. So there's no free money out there. There is a margin requirement for writing the naked positions, and that margin requirement can quickly consume the student's buying power. Other than that, it's pretty straightforward. So if you're starting off with your students and they're trading options, they can come here and just write some quick contracts. They can go long, they can go short. They can be covered naked. It doesn't matter. The StockTrak platform will calculate the margin requirement properly. If I owned Tesla and I went to write a call on Tesla, the platform knows that that's a covered position and there will be no margin requirement. But then tomorrow, if I come in and I go to sell my Tesla, which is covering my naked option, then my margin requirement will jump up and my buying power, will drop significantly. So pretty bulletproof. We've tried to program this to be exactly the way it's traded at the Chicago options market. But that's not the point of today's call. Today's call, I really want to get into the option spreads, because this is really what we're happy about. And I think that the students are really going to learn a lot from this and enjoy this. I remember 30 years ago when I was taking the derivatives class, I was getting so confused between all these types of trades. And that's one of the reasons I came up with StockTrak. But let me just walk you through the option spreads here. So we have 21 types of spreads in this trading pit now. So let me scroll the screen up. So now the students can do a covered call, a covered put, the married call, married put, bear call, bull call, bear put, bull put. The straddles are here, the strangles are here, the butterflies are here, and it just goes on and on to the collars, condors, and iron condor. What we do is we really hold the hand of the student as they go to make the trade. So if I'm going to do a covered call, I'm going to give it a week here. Oh, you know, I'm sorry. In this position, this account, in this account, I've used my buying power here. Let me try a different stock. Not quite so expensive. Yeah, in this account here, I gave myself 100,000 for this demo. I would recommend that you have your students have $1 million if you're doing a lot of option trading. And that's just because with some of these covered calls, there might be, you know, here I'm trying to buy 100 shares of Tesla, and I hit my position limit there. But with Coke, lower price stock. So what I've done here is I punched in covered call. I've chosen expiration, and then it grabs my first leg. So my first leg is to buy 100 shares of Coca-Cola. And the second leg, it defaults it to write, and it defaults it to 1, and it defaults it to call. You know, so now, you know, my options here as the student is to pick the strike price. So I can scroll down. I can see that Coke's last trade was 60. So if I want to do a covered call, I might buy the stock and write the 61 call. And then leg 2 drops in over here. The last price on that was 20 cents. There's a bid ask, day's volume. And that pretty much, you know, lays it out for the student to trade the contract. And then we've done a lot of work with our descriptions over here to really spell out for the student what the strategy is and why they might want to do that strategy. So I'm just going to stop there for a second. Are there any questions from anybody? Okay, and you know, feel free to, you know, to chime in if you've got any questions. So we got a nice paragraph here. A covered call is an option spread with 2 legs. Buy 100 shares of underlying stock for every 1 call of option contract that you write. The strike price of the option should be higher than the stock's current price. This strategy is used when the investor expects the stock to trade towards the strike price, but not above it. Maximum profit is made when the stock price reaches the strike price. And then we've got a nice diagram here. So going along the stock is the line at the 45-degree angle. Writing the call is this line. And then finally, the covered call is the yellow or orange line. So really try to lay this out for the students so it's crystal clear what they're doing it and why they might want to do it and what their payoff diagram is. So I think that's you know, should be really helpful for your students. But the covered call is kind of the starter trade. If we want to move into something like a bull call spread. So if I stick with Coca-Cola and stick with the September calls, now again, this laid out the strike for me and whether I'm buying or writing. So my first leg is I want to buy. If this is, what was the price here? Yeah, it was around 60. So I might want to buy the 60 call and then write this 61 or 62 call. And then it lays out the trade. So leg 1 is I'm buying at 75 cents and one that I'm writing is at 4 cents. So again, a nice little description of what it is, clearly showing the student that the first leg, the strike price should be lower than the second leg, and then drawing the expected payoff diagram. So again, very straightforward. The margin requirement calculates. So on a trade where the strike is off $2 on one trade, this is the covered position, so there will be no margin requirement for this. If I was doing the bear call, where writing and then buying, then the margin requirement is going to be the difference between the 2 strike prices. So those calculations are all done on the back end, and the students will see their buying power change, and they'll be able to see their margin requirement as well. Just a few notes about this. As we've been demoing this to other professors and having a lot of professors use this over the summer, I've kind of come up with 5 key points to make this a success for your students. So I've already mentioned a couple of them. So number 1, encourage your students to trade liquid positions that have volume, and that way there's a good bid-ask spread. And number 2, have the students focus near the strike, because the farther away that they get from strike prices, there might be no volume, and they might catch one with the volume of 1 or 2 contracts being sold today, but then next week, if they want to sell it, if there's no volume in the real world, we're not going to let them close the position. So have the students focus, near the strike price, and pick the stocks that have lots of options, lots of open interest through a variety of strikes. Point number 3 that's important is we do not allow students to have opposite positions. So if they say, okay, Tesla's going to be my stock, I'm going to write covered calls and do bear call spreads and do the condor and the straddles on Tesla, they may end up trying to do a position that puts them in opposite positions of the exact same option. And we don't allow that. We found that in the past, students were just getting too confused. So if they are long a call, they can't also write it in another trade. So if they're long a call and they want to write, then it's going to force them to sell to close the long position that they have. So my third point is no opposite positions can be held. So if you're going to have your students over the course of the semester try to complete all 21 of these trades, then I would really recommend that you have them pick 21 different stocks and decide, I want to do my cover call on Coke, I want to do my covered put on something else, but I would have them find 21 different stocks with liquidity on all the options and pick a stock per strategy. Otherwise, they're going to get confused because they're going long this, short this. And then once they go to look at their open positions, they're going to be confused of what is tied to what. So my point 4 was to use different stocks per trade. Okay. Any questions here? Okay. And then the 5th point was that if a student comes in and does a position that has 3 legs on it, they're looking at their count, they might see that they got a profit on one and then maybe a little bit loss on another. And if they're in their open positions and they go to close the trade, it's not locked together. So even though this long butterfly might be 3 specific trades, when they go to view their open positions and they click on one and they go to sell it, we're going to let them sell just that one leg. And as a result of selling that one leg, then that might impact their margin requirement and their buying power. Because in this position, if they sold off something that they were long, then suddenly then they've got some exposure here on these calls that they've written. So the students, they can sell one leg at a time, but as soon as they make that trade, this platform is going to recalculate their positions and recalculate their margin requirement and recalculate their buying power. So I think from a teaching point of view, do you want them allow them to break their strategy, or do you want them to come back in and reverse the position in one trade? So that's a question that you'll have to decide. So I just want to review those 5 points that I think are key to making this a success for your class this semester. Number 1, have the students trade the options that are liquid. Number 2, have them trade the stocks that are near the strike price. Number 3, no opposite positions. They can't be both long and short the same contract. That being said, if they want to do some trade above the strike price on Tesla, then well below the strike price in Tesla, they're welcome to do that. But with the exact ticker symbol, we do not allow we don't allow them to be both long and short. And so that's why my fourth point is we really do recommend that you have your students, if they're going to do all 21 of these trades, to find 21 different stocks. I think that will help them understand what they're doing and how the prices change over time. And then the fifth point was these are not locked. So if you're doing a butterfly, these 3 positions, we trade them as one, but when they show up on their account and their open position portfolio, if they want to close one of the legs, they're welcome to close one of the legs. So that's the pit. I do want to show you, about our option chains. So under investing research, with all these quotes and research, we do have the option chain here. So professors are asking me as I do these demos, well, what information does StockTrak provide about the options? So we default here to General Electric when I clicked on option chain, but if I need to change it, I can. So we do show the last price, we show the bid, the ask, we do show the volume and the open interest. And then we do our platform. This is a third party that provides this data for us. It's showing the implied volatility and the options delta, gamma, and theta. So those are the 3 Greeks plus the implied volatility that we have. So you can have your students, as they're studying what options that they want to do, come to our options change, punch in the different things up here across the top, and then look to make sure that there's open interest volume before they go in and make the trade. So I think this is real helpful. Just one thing that I find a little bit odd with this interface is the 3 that are selected are the 3 that are shown. So if I don't want to see this week's, I just click it, it turns back to the gray. And so now I'm just comparing the 8ths to the 15ths. If I want to go up here and expand the moneyness, I can get it to show a little bit more. And then it will show me now I'm 20% away from the money on General Electric. Yeah, and then on our platform, as the students, when they come to their portfolio summary, down here is where they're going to see their buying power. So if they've written a naked option, that buying power is going to be 20% of the underlying value, plus the premium received minus the out of the moneyness. And just another quick comment that professors ask about our options and the margin and the buying power. With the StockTrak platform, we do not do margin calls. So if they start writing options and option positions might move against them, and if their buying power ends up going negative, we can't issue a margin call or force them to trade a position. So what happens is their buying power goes negative. And when the buying power is negative and the students log in, they'll be alerted that the buying power is negative. And so they can't open any more positions while their buying power is negative. They can only start closing positions to free up buying power. So the students will be able to see their margin requirement here. Their buying power is here. And then, of course, we also have the buying power running across the top of the page here. So this webinar was scheduled for 30 minutes. I'm at 27 minutes. So I just want to see if anybody has any questions.
Mark, can you hear me? I have a quick question.
Yes.
Is it possible now, or might it be possible in the future, in the options trades for the professor in the class setup to only turn on a subset of the options? The only reason I say that is let's say you're teaching an investments course and you really only want to cover 3 to 5 of them. And if you have all of them on, the students are going to spend all their, you can tell them, I only want you to do these 3 or 5.
Yeah. That's a great idea. So this semester, I don't have that ability,
Okay.
but that's something that we could look at for January for next semester. So where would you draw the line? Just keep them at the 2-legged trades, and maybe we should break this up into, you can enable 2-legged and then everything else.
Yeah, or you don't, there must have been a reason you decided not to do the protective put, or is that
It's the married put.
you're calling it the married put?
Yeah,
Okay.
we did a lot of research on that, and we kept seeing people naming things differently.
That's okay, great. Yeah, I could think about it and tell you what I think, but probably what I call the protective put or the married put, probably the covered call, and then maybe a few of the spreads. I'd have to check, since I'm not right now teaching investments, I'd have to check what are the maybe 6 that we cover.
Okay. Yeah, so I press,
Maybe that's a good idea, maybe it's not. I don't know what the other faculty think. If it's an options course, you want them all on. If it's a different course, maybe you just want to focus their attention.
yeah, well, Tom, let's pay attention to what the professors are saying this semester. And if we get a couple professors asking us for that, then it's something that should be an easy fix for us to do for January.
Right. I think that's great feedback from Professor Cam. I like that idea.
Yeah, and so what we did here, so we called it in here the married put, but then our description, we labeled it both because we had more room.
Oh, great, I see it.
Yeah, but maybe I'll put it in here if there is room. I know that some textbooks were calling it protective and some books were calling it a married put. Okay.
Thank you so much.
Yeah, thanks. Any other questions? Okay, so what we're going to do is, this was just limited to 30 minutes, so I don't want to go over. So we're going to stop the recording. We'll send everybody a link, and then I'm going to send you my 5 suggestions to making sure that your option trading goes smoothly for your students. There's 5 things that I kept repeating, so I want to make sure that everybody has that, going into the class for the students. Okay, so any more questions? If not, then thank you all very much, and look for an email from me in the next couple of days, okay?